First, let me say thanks for coming on the show.
Thank you for having me.
We've had so many great guests who I believe are entrepreneurs like you that have started businesses, whether it's developing investment strategies, whether it's developing fintech platforms. Our audience, a lot of financial advisors, a lot of RIAs, and of course in the broker dealer community too. And so, you know, let's do this because, you know, obviously there's just a dearth of investment strategies in the private market world that exist today, and more keep coming. And so I was really taken with your background. And first let me say I started at Merrill Lynch myself in my career. So
Okay, what year?
I'm an older guy. I started in '99, but
Okay.
I remember it was a very tumultuous time right before the tech bubble popped. I
Yeah.
started my first day in the 55th and Fifth Avenue Merrill Lynch office.
Sure.
Um, and they had just
Was that was
announced,
that being run was that at that time? Was that Tom Fickinger that was running that at that
no,
time?
John Brett was the manager.
Okay.
He
Okay.
was the manager, about 6'7", tall guy, very
Yep.
intimidating, scratch golfer, used to commute every day from Princeton. And he would always walk by the bullpen at 7 a.m. You were a rookie like me, you better be at your desk, like
Yep.
cold calling small business owners.
Yep. Yep.
But I remember the day I started, I didn't see him once because the Merrill Lynch had just revealed they were the first wire firm to come out with the Merrill Lynch Unlimited Advantage. And
Yes.
that was the first real UMA by a wire, 1% management fee, full financial planning, access. You got access to everything that Merrill did in this 1% account, and trading commissions were going to go away. And all his big corner office guys were ready to walk across the street to Smith Barney,
Yeah.
and he had to
Yep.
sit down and try to keep them there. And
Yep.
now look at us today.
Yeah.
It's crazy how much things have changed, and they were always at the forefront. I give Merrill Lynch credit.
Yeah.
Mother Merrill was always at the forefront. So yeah, I wanted to talk to you and understand, like, while you were at Merrill Lynch, you're a managing director, correct?
I was a managing director. The last role that I had, Derek, I was one of six that ran the firm globally. So my P&L responsibilities were the state of Florida, state of Alabama, state of Georgia, Latin America, and the Caribbean.
Oh wow. Okay, so you had a lot that you were overseeing.
Yes. It was a $2.8 billion P&L.
No kidding. Wow.
Yeah.
That's
It's big.
impressive. So what I mean, a massive obviously accomplishment, climbing up the corporate ladder at Merrill Lynch,
Yeah.
being in a position like that with that kind of P&L. So you've spent decades, inside Mother Merrill, serving the, ultra high net worth clients. Let
Yeah.
me ask you this. What did you see inside the wealth channel that convinced you that venture capital needed to evolve? And that you could build something different?
Yeah. So Derek, I think it's important to maybe even go back pre-Merrill Lynch. So I was an entrepreneur very early in my life cycle, I guess is what I should say. I started three businesses. I ended up selling those three businesses and then just had this opportunity at Merrill Lynch, which I took. I honestly had no intentions of staying at Merrill for more than a year.
Hmm.
I figured that I would get there and I would learn a lot and I'd get exposure to New York and get exposure to a lot of things that maybe I hadn't known yet. And I would leverage that in whatever business I was going to start. But that ended up being a 21-year career, which was unbelievable for me, to be honest with you. I mean, the Mother Merrill was an incredible organization. The level of education and experience and knowledge was just, I don't think I could put a dollar amount on it. So, but if you know anybody who knew me at Merrill, they would probably tell you that, Ransdell was always a little different. I tended to be on my horse out in the future 4 or 5 years and then kind of coming back and saying, hey, these are the things that we need to do to be successful in the future. I think that's really one of the main reasons I was able to climb the ladder, as you said, the way that I did. But I was the inventor of supernova. I don't know if you remember that. I did a lot of different things that were always kind of future forward. And so the reason that I left Merrill to start Fuel Venture Capital was simply because, again, I was out there in the future, and I believed at my core that things were going to change in significant ways. Um, I maintained a private portfolio as well as a public portfolio. I had an outside interest approval, and so I was an early investor in a lot of really marquee companies. And in 2014, when we started seeing the exits in those companies, and I started kind of comparing my public to private, um, and started to see things like, um, pre-IPOs. If you remember back in those days, we used to call our very best, clients and say, "Hey, we've got 1 or 200 shares of whatever company that's going to go public." And I thought to myself, that's just not going to be the case. If you think about Amazon, right? Amazon went public in 1997, but it had only been private for 3 years. It had top line revenue of $30 million at that time. I mean, we haven't seen anything like that since, right? If you fast forward to even Uber, they were doing over $1 billion in revenue and had been private for 14 years. And so that is what I kind of thought was going to end up happening. And I sat down with all my bosses. I said, "Listen, we're Merrill Lynch. We're supposed to be on the cutting edge. You made a comment a few minutes ago. You said Merrill was always on the forefront. Well, the world's about to change, and we need to change with it in order to be out front." It's not that people disagreed with me, but it wasn't going to happen in a time frame that I felt was important. So instead of looking the man in the mirror in disgust every single morning, I decided to do something about it, and that's what I did. I left, and I started Fuel Venture Capital in 2017.
So you make a great point. So many firms that are the leaders in their industry, they all have that one thing in common. They're out in front with the latest and next trend, whatever the product is or whatever. And Merrill did a great job of that for years. Like you said, like I
Yeah.
mentioned before, with the fee-based account, they were the first to do the cash management account. They started
Yep.
selling credit products to the business and the individual. They knew multiple products kept them there longer, right? And a lot of, I think, of what Amazon and other folks have tried to replicate is that sort of model. But then there's the area where you are, whereas you identify a skill set you have and you really hone your craft and you become really, really good at that one area. You're the expert, right? And so you've decided this is where you're passionate. This is what you have a skill set for. You identified early that you could figure out what companies to consider investing in. Um, Talk about COVID, because I know from looking at some of the content you put out, um, that during that period you deployed more capital than all the prior years combined, right? Was that counterintuitive? Like most people were pushing away, you were leaning in. Was that conviction or just calculated risk?
Well, I think for us, COVID was almost a telltale, right? I mean, with what we do, our job, and I mentioned it already, but our job is to really ride our horses out into the future. And so here we are in 2020. Who in the world, in 2019, if I would have said to you, Derek, next year the population of the planet is going to be locked down in caves, you would have laughed at me. You would have said, "Make sure that this guy never gets on our podcast because he's lunatic." But that's exactly what happened. And so, how did the world actually continue to exist? How did we get through the days? It was all technology, right? We had food delivered to our homes. We leveraged this technology platform called Zoom to continue to conduct business. We and by the way, that was the beginning of offices as we used to know it, and going, traveling into New York City every single day after an hour living in Princeton or whatever, as you were saying about John. you don't have to do that. You didn't have to fly to Miami to have a conversation with me today. And so that's all technologically driven. So for us, it was about what are the products and the services that we as the human condition is depending upon. And and because we had nothing to do but work, I gotta be honest. I mean, it was the greatest time ever because there was just nothing, you know, all you had to do was work and serve your investors and think and write and get smarter. And it was amazing. But yeah, we deployed in 2020 more than we did the 3 years prior combined.
You know, I want to get into AI, and I know you do too, because you've spoken about it, redefining work and wealth, and you just touched on some of those points. But private equity right now has been challenged. Obviously, it's a matter of public record now. It was an incredible environment to be putting capital to work. Interest rates were low.
Mhm.
Your model on getting your multiples was much easier. I listened to Michael Arrighetti, CEO of Ares, on Bloomberg today, along with a lot of other CEOs of private market firms that are all sort of out there, um, addressing some of the volatility in the market. And he made the point like, there's a lot of companies that, yeah, they probably wouldn't have gotten capital had rates been more normalized. There's going to be some of these exits are going to be tough. Like there's going to be, and there's a big dispersion, which has always been a matter of public record between top tier private equity managers and the bottom. Like they said we do a lot of secondary investing, and what we've seen is there really is a very small number of managers that actually generate alpha when it comes to private company investing, whether it's VC, whether it's more up the middle market, whatever.
Mhm.
What do you think you do differently? How do you think about it that you feel helps you distinguish your strategy, your team, and the way you're able to generate alpha as you look out? Because we're in a new rate environment, even though who knows, maybe rates are going to get cut by 200 bips,
Mhm.
based on, the narrative right now with inflation and the war. But
Mhm.
talk about that a little bit for our listeners.
Yeah, I think it's important actually, because I mention this to investors all the time. I'm very proud that I came from the public markets because I think that gives me a tremendous amount of institutional uh, knowledge. I'm very proud of the fact that I ran a very large business because I was ultimately responsible for, I think it was $380 billion of entrusted assets. Those are all really important things. So again, I was an investor in venture capital as I was a leader at Merrill Lynch and an investor in the public market. So to me, it was like, okay, there is a serious need here for someone to come into the market and provide a access point to individuals who do not have access right now. I mean, the truth of the matter is, Derek, over the last 25 years, the people who have been able to really benefit from the innovation economy is very large institutions and the wealthiest of the wealthy, right? It's the greatest private club that exists. You have to know somebody who knows somebody to get access to the cap tables of these companies. And it's a lot of work. I mean, what I do today is exponentially more difficult than what I used to do. There's no question. So when I built the firm, I wanted to build it in this institutional public market thought process and come into the venture capital space, which was viewed by a lot of investors as being, like you mentioned earlier, cool or, not as buttoned up. And so my first employee was my partner, Maggie Vo, who was a long short hedge fund manager. And I brought her into the firm and made her my chief investment officer. Now, I'll pay you $10 if you can go and find 12 venture capital firms that actually have a chief investment officer. It doesn't exist. And if you can find one, I'll give you another $10 if they're actually from the public world and understand all of that stuff. And why did I do that? Well, I wanted to bring somebody in who would look at these portfolios or these potential construction of portfolios, the identification, the sourcing, and look at these and say, okay, here's the portfolio, but how can we think about this from the downside perspective? Right? Not just throw 20 or 30 companies up onto the wall and wake up every morning and pray that something works out. Pardon my language, but I think that that's a real, I won't curse, but it's a real BS way to be responsible for other people's money. And I never believed in that. We call that spray and pray. And I don't think that investing other people's capital and their life savings should ever be something that it's a spray and pray. So I built the firm to be exact, to be very buttoned up, to have a very strong thesis and move forward that way. So everybody on my team has some exposure to not so much anymore as we're continuing to grow. We're on our fifth fund and we're doing something that nobody has ever done before right now. And so the firm is starting to look a little different. But from the very beginning, it was about building a team that has a different way of looking at the asset class so that we could actually be different in the asset class. And, again, I, I, I understand financial advisors. I've been serving them for over 30 years. And I know factually, because I was one of the people mixing the Kool-Aid for 21 years, that those financial advisors didn't have access to this asset class and that they were going to need it because their clients were going to demand it. And if they don't get it through their financial advisor, because we live in a world right now where as a consumer, I can have whatever I want, whenever I want it. I like you, Derek, but if you're unwilling or can't give it to me, I will get it. It's not difficult for me to do. Information has been completely democratized. Our clients have information that we don't have because we're busy doing our jobs, doing podcasts, doing portfolio reviews, doing construction analysis for our clients. They're just sitting there looking at their phone all day long and information's pouring in. So I think that that's really the big difference between Fuel Venture Capital and other venture capital firms that are out there. We're really focused on the two-legged individuals who we believe deserve to have the access just like everybody else does.
Access to private market strategies has gained so much attention. Obviously, with my firm Scion, we have two private credit fund and infrastructure private fund, and we certainly are in the center of that. What's the landscape look like? You're, I believe, running 5 funds, correct?
Yeah, we're on our fifth fund now. That's
You're on
correct.
your fifth fund. They're not fund to funds. You guys are holding individual positions across your portfolio, or are you investing in secondaries, a little bit of both? You buying primary funds? Talk a little bit about the portfolio construction.
So the first 4 funds are alpha funds, active management by us, identifying the companies, getting on the cap tables. And then our fifth fund is something that has really, quite frankly, never been done before. It's something that we've been proof sourcing for the last 3 years. It's a beta-like product. So if you think about the NASDAQ 100, you were a portfolio constructor, you have the NASDAQ, and a lot of advisors will then build around that, satellite themes around, having the index. So we have something which is called the Innovation 100. It's the top 100 technology companies on the planet. I mean, you throw out a big name, I don't care what it is, if it's SpaceX.
SpaceX.
Okay, well, we've got it. The difference is we're doing it in a little different way. So you started in 1999. 1992, 1993, private investors in San Francisco started taking capital and investing it into what was then beginning to be known as founders and technologists. That is now called venture capital. And we believe at Fuel that the next iteration of all of that is private capital investing in the employees of these massive companies that represent the innovation economy. So what do I mean by that? Every single year, Derek, $33 billion of employee stock options are flushed down the toilet. simply because the employee does not have the ability to exercise those options. Maybe they don't know how, they don't know, understand what it really means to them from a multi-generational wealth perspective, or they just don't have the funds.
They just let
Banks
it
can't help them.
lapse. They just let it expire. They don't go to the bank and get a
Well, a
loan to
bank
buy
can't
it.
give them, banks can't give them a loan because it's non-recourse. So they
Hmm.
can't give them a loan. So what Fuel Venture Capital is doing right now with the Innovation 100 is we take our investors' capital. We have 100 of the companies, again, whatever name you want to throw out, it's in that 100 index. And then I have a slew of what we call scouts in San Francisco. The moment that the sun comes up to the, wee hours of the morning, we're meeting with employees of these companies. We're talking to them about their situation, just as a financial advisor would do in a financial planning perspective. We have these conversations. Actually, the financial planning questionnaires that we used to have at Merrill Lynch, we use today
Yeah.
in these conversations. And we then identify the top 1% of employees in San Francisco at these companies, and we fund them. And then what we do is we get an interest rate to the exit, and we also get what we call an equity kicker. So if we're going to provide the capital to exercise 100% of the stock options, we want 30 to 40% of that for ourselves. And the bottom line is, Derek, we tend to own these companies 60 to 70% less than what you'd be paying for them in the secondary markets. Usually 30, 40% less than the 409A valuation. So, the point is, it's impossible to have access to these top 100 companies from a cap table perspective, from a traditional, VC perspective. This really isn't VC. It's very different. But we have our investors have access to all of it. And because of Maggie's long short hedge fund background, we own it 60 to 70% less than the current market price.
So it's kind of like almost akin to you creating your own secondary market.
It's not a secondary market because secondary, prices are actually trading at a premium,
Right.
but it's a very, it's again, it's the newest way for private capital to access great companies at a discount and have, again, what's our theme? What are we trying to do? We're trying to provide access to people who wouldn't normally have access. This is a very diversified portfolio from a risk perspective. These are, in order to be in the portfolio, my investment team has to believe that there is a very high probability of exit within the next 18 to 36 months. If we don't feel that way, the company doesn't end up in the portfolio. So very late stage companies doing hundreds of millions of dollars in revenue have the biggest investors on the planet on the cap table. So there's no really concern that the company's going to run out of money. And, we have insider information about pretty much all of them and when the plan to go public. So it's very different, never been done before, but that's our fifth iteration. And again, it was really designed for your audience's ultimate client. And quite frankly, to put your viewership, financial advisors, in a position of value add and strength. Because the truth of the matter is, most financial advisors right now are very populated space, and they are all talking about the same damn things. And I hate to say this, but I think I can say this from a humble perspective because I mixed the Kool-Aid in that world for a really long time. I came here, I got away from the bubble. So I know a lot about how investors think about things. And every single, we call them partner firms, every single financial advisor that hooks up with us, it becomes like a kid in a candy store. They're having conversations with their clients they have not had at a robust, passionate, energized way because everything else is abundant. They can get it on their phones if they want to. They can get it anywhere. If I want to own Apple, I can own Apple from 100 different locations in a different ways. But can I get access to the Replit cap table? The answer to that is no. Unless you know someone who knows Derek, who knows Jeff Ransdell and Fuel Venture Capital, that's not happening.
Hmm. I assume these are fairly illiquid vehicles and it's accredited only type.
Yeah, yeah, it's accredited. Our investors have to be accredited. That's correct.
Okay. And the time horizon is
3 to 5 years on the innovation fund.
okay.
On
Um,
our flagship fund two, which is an alpha-driven, more pure venture capital firm,
yeah,
that is it's a traditional 10-year fund. One
10-year
of the things,
LP.
I'm sorry.
It's a 10-year drawdown structure?
No, the investment period is 5 years, and the drawdown from the capital calls.
Yeah, just I'm assuming it's a right drawdown
Yeah,
fund from
yeah,
capital
yeah,
calls,
yeah.
but it's a 10-year. You should expect to be in the fund for 10 years.
What we do on that, Derek, because I don't want my investors in there for 10 years, we're not allowed by proxy to retain earnings, nor are we allowed to reinvest. So when we have an exit, the dividend goes out to the investor.
Okay. Okay. Talk about the fees.
Traditional 2 and 20.
Okay.
Now, the difference on that, Derek, is the 2% management fee gets returned to the investor at the end of the cycle. So we're really just using the 2% to manage the company, do the things that we need to do to construct the right portfolio, maintain the right portfolio, and then we return that at the end of the cycle. And you asked me that question a little earlier about what makes us different. I don't really view us as true, like pure venture capital. I think we sit somewhere between venture capital and private equity. We have private equity mindset. We're very, very focused on operational excellence. We have incredible relationships with our founders. We're very focused on building real businesses with profitability. Um, we just choose to invest only in technology. So instead of investing in an antiquated business and going in and changing everything up, we want to invest in a technology company that we think has, exponential returns, but use those same philosophies. And so I think that that is a really big difference for us. And again, it kind of goes to that whole getting away from spray and pray. The companies that we have to invest in, they have to understand that we're going to be co-building the company with them. And usually that's the last dinner before we write the check. Do you understand before you take our capital what this means to you? It's not just take the capital and go do whatever you want to do. It's capital. We're going to be involved. My team's going to have KPIs. We're going to be meeting all the time, and we're going to be giving you advice and counsel, and that's what we do.
With respect to the companies and where you're investing, I mean, there's just so much noise right now with AI and disruption. Software is taking it on the chin really hard. How do you separate the real companies that have the technological edge versus, others that are maybe just marketing hype?
Well, that's where our team comes in, and again, that's I think one of our big differentiating factors. These it's interesting. The larger the fund, like these multi-billion dollar funds, if I was an investor, I don't think that those types of funds are really properly positioned for the wealth clients, even though, you know, like a Merrill Lynch, for example, that's about all they'll do because, it's got a big marquee name and nobody's going to get fired, right? But I think that's going to continue to go away. I'm not going to mention names, but I will tell you that my funds have some of, if you think of the biggest Wall Street names and you look at the C-suite of those firms,
Hmm.
they're individual investors in my funds. And if you ask them why, they'll tell you, quote unquote, you're a Puritan, right? We've become an asset allocator. We bring in a ton of assets and we'll kick out 125x or 150x, 1.5x, and everybody's happy. But we have a management fee and we're really asset allocators versus, you're investors. And so I think that that's, another, big differentiating factor for us. Um, and ask that question again. I think I lost you on that.
Oh, just about what companies, how do you discern between
Yeah.
who has the real technological chops versus a lot of these guys just kind of like marketing hype, right?
Well, and again, it goes back to my chief investment officer, Maggie, and her role, but we deploy what we call phased investing. So unless it's like a company like a Replit or a Mercor or something like that, but if it's a younger company, we will deploy a much smaller first check. Could be I mean, Derek, it could be $250,000. It could be $500,000. And we tell them, look, it's going to be a smaller check in the beginning, but we want to get to know you. We want to get in the sandbox with you. We want to understand what's going on. We want to see if we work together well. And if all those things go well and we have the KPIs, then we'll invest more and it'll be larger. And that's one of the things that we do. And it has protected us a lot from a lot of ugly things,
Hmm.
because you really don't know anything until you're in the sandbox. But that is one of the things that we do. It's phased investing. I think that has been a really big differentiator for us. We don't just write, and that's kind of where I kind of ran off the rails a little bit. Where I was going with that is your really large funds who have billions and billions of dollars, they got to deploy it. And so what you'll see is they deploy it in some of the most, in my humble opinion, some of the craziest things I would never in a million years invest in. But they do because they can. Fuel venture capital, we can't. That's not who we are. We have partner firms, individuals like yourself who are facing off with clients who aren't going to understand things like that. So, I think that's I think answering your question. But with AI right now, 2026 is a year where, it's going to be companies that are actually scaling with large institutions, where these large institutions are leveraging their technology to bring serious profit margin to the bottom line. And you're starting to see that now. Jack Dorsey just announced last week, I don't know if you saw that, but he let half of his employment go. So, half of his entire staff was let go. And so now you have, an OG that has gone through that window. You're going to see more technology companies doing it. And what will follow then will be more antiquated businesses that right now, IBM just did an interesting study on large S&P 500 companies that are leveraging AI. And 95% of the companies in this study are doing pilots, but they're actually not taking, the outcome of those pilots to the bottom line and letting employees go. And that is going to be happening over the next 12 to 18 months in a very serious way, to where people I don't think are prepared.
So we really haven't begun to see the real true implications of AI in terms of what it can do for productivity. And I know I heard a broker-dealer chief investment officer recently of a large national broker-dealer say he thinks utilization rates are not even near 50, 60% yet. So
No.
that kind of, corroborates what you're saying. There's a lot of runway, um, and a lot of opportunity. But again, it really comes down to manager selection. The difference between the top tier and the bottom ones is vast. And there's a small group of folks who really generate the alpha. But it sounds like you guys have built a really good platform, and there's no question you're in the right spot because everybody's always looking for growth. So this has been super. I really appreciate you taking the time to come on the show, and we'd love to have you back anytime.
Oh, love that. Yep. Thank you very much.
This video is for informational purposes only and should not be considered or relied upon as investment advice. It may not be copied, quoted, or referenced without Cyan Investment's prior written consent. Do not rely upon any opinions, predictions, or forward-looking statements contained herein. The views expressed do not constitute an offer to sell or a solicitation to purchase securities, nor do they constitute the endorsement of a particular asset class or investment strategy. Neither Cyan Investments nor its affiliates and/or subsidiaries warrants its completeness or accuracy. Certain information contained in this video may constitute forward-looking statements that may be inherently unreliable, and actual events or results may differ materially from those reflected or contemplated herein. Cyan Investments expressly disclaims any obligation or undertaking to update or revise any information included herein. The views expressed by the guests or participants are their own and do not necessarily reflect the views of Cyan Investments, LLC, or any of its subsidiaries, officers, or staff. Please be aware of the real risk of loss in following any investment strategy. No investment strategy or asset class referenced herein is intended to be construed as investment advice. You should make an independent, informed decision regarding any investments or strategies only after reviewing all relevant offering or disclosure documentation with your financial professional, and after considering your objectives, risk tolerance, and best interests before making any investment in any financial product. Registered personnel should review any business development initiatives addressed herein with their respective compliance and legal departments. Coverage of such topics should not be construed as compliance or legal advice. It is at the discretion of each respective firm if such practices are consistent with firm policies and procedures.